This is the current federal tax developments for the week of June the 22nd, 2020. Current federal tax developments are brought to you by your state society of CPAs and by Kaplan Financial Education. I'm Ed Zollers, and from here in Phoenix, I'll be talking to you about what's gone on this week in taxes. We have a few developments this week that came from the Payroll Protection Program loans that we've been talking about for a little while here on the program. We also have some developments with qualified retirement plans and IRAs for what we got in the CARES Act, some relief the CARES Act gave us in that area. And we also have a court case about how you properly file a tax return or other document and have proof of timely filing, and more importantly, for the taxpayer in question, how you don't do it, what went wrong. And so we'll talk about that in this week's session. But let's start out with our Payroll Protection Program loan issues. And one thing that happened this week was we had a couple of big developments related to the changes in the law that were made as part of the Paycheck Protection Program. I always want to say payroll, for basically Flexibility Act, that added and changed the terms. And we got revised forms 3508 and 3508EZ from the Small Business Administration. Those are the forms that we use to apply for forgiveness for these loans. And one of the big things we got this week was we got a brand new short form. The easy version of this form is available, and it's allowed to be used in this particular case if you meet a few criteria. And the basic criteria you've got to meet, and that criteria that you need to meet is found on the application form instructions. So you'll see it there. They'll tell you how to meet it. If you're self-employed and have no employees, basically under the rules now, we pretty much know that if you have no employees and you're self-employed, reality is that you get full forgiveness, right? You're going to get that, and you probably could apply for that instantly. They also have a couple of cases of simple cases where you haven't reduced employees. It's going to be a simple thing there, and you're just applying for straight up forgiveness. In those cases, this is going to be a pretty easy run. Okay. Now, we're also going to have, as I said, the short form for a limited set of easy applications. It also gave us a few additional issues and some rules because, we had some basic issues there. And one of the key things it tells us is how we deal with the 8-week and the 24-week election. So it talks about those issues. As you may remember, if you got your loan before June 5th, you might choose to use an 8-week time period and not a 24-week time period. Why would you use 8 weeks? Probably because you're going to keep all the employees during that period, but you're not sure you're going to be able to make it for 24. And if you qualify during 8, why would you wait for the 24-week period? It seems like the only thing that could happen is things go wrong as opposed to things get better. So you'd apply for the 8-week forgiveness. That tells you how to make that election, tells us how things change and how things are different with the two of them, right? And some of the things we're going to find out there is that we did get down to the issue of, one question I had a lot of people ask me was, what was going to happen now with 24 weeks? Will owner employees be able to, get a full 24 weeks of pay, or are they going to be limited to a lower number? And I said all along, I told people that I really did think that those who were not owners were going to be able to go up to the maximum amount, which would be right around, I can't have my number in front of me right now, 40, let's see if I get this, going to be essentially at over $41,000 that we could do for a non-owner. But I did think there might be concern that they wouldn't let owners go that high. And in fact, the SBA tells us flat out in another item we'll talk about here in just a second, that they were concerned if they let owners go to that higher number, because remember, we don't get any more money. Even though it's 24-week period versus 8-week, it's not as if they gave us more money. They didn't. They just said you got 8 weeks versus 24. So what's going to happen is we're going to have a limitation on owners. Instead of being able to triple the $15,385 number, or effectively triple, we get $1 difference due to rounding, we're going to be limited for owners, and we find out later self-employed and partners on this application form are going to be limited to 2.5 months of 2019's compensation, or $20,833 maximum. Now, there is some question about whether that does or doesn't include their retirement plan contributions or their contributions to basically to, got to say healthcare, right? Think about the right thing here in just a second. And the answer is it's not totally clear. Now, the AICPA this week in a town hall was reported as saying, and there is some support for this idea on the application form, but you may be reading a bit into it, so I'm a little concerned about this, especially because I'm not sure, given some of the history involved in how the program's moved, and the AICPA has not necessarily seemed to be in the loop, shall we say. And by that I mean, remember the day they're going to put out a big to-do about putting out their forgiveness application spreadsheet, and just before they're going to do it, the SBA releases the actual form. Well, to me, that indicates pretty clearly that the AICPA didn't know the form was coming the next day, which means that you didn't have a contact that said, yeah, guys, you really need to look for this. We're going to have the form out on this day, so you're going to have to modify your spreadsheet. So don't go telling people you're going to do a spreadsheet tomorrow. Just let the form come out. So whatever, it was there. But what they said, which does make a little bit of sense, so you can follow it if you want to, and hopefully they've got a good source now for this. And again, it was said in a town hall, so it's not really in any way, shape, or form something you could necessarily rely upon. But the idea is the form does tell us that S corporation shareholders do not get health insurance added on, because if properly done, it should be in their W-2, right? So it'd be in their cash wage number. They're taking that to imply that if you were let's say an S Corp shareholder, your retirement fund, which is not in that number, you would be able to take it. And conceivably, extending this a bit more, a C Corporation shareholder would be able to take both their retirement pay and their health insurance. Now, I hope that's right. I hope that there's no limits there and we can do that. I just don't know I want to go out on that limb right away. I would tell clients, like I have up to now, we know the things that are for sure. Fill up your forgiveness with for sure expenses. If you can't get there with for sure expenses, then we start working on the other expenses, right? So, like I said, I would like to see that we have some other way to fill up the list. But nevertheless, it may be possible to use retirement plans to backfill, even if it's to owners. And one theory would be, well, you do that because it's going to be very difficult in many cases to tell where the retirement plan money will eventually get allocated. But my problem with that theory is it's just as difficult for a sole proprietor. If you're a sole proprietor and you have a cross-tested profit sharing plan, we really don't know how much is going to your account. It's the same difference, so I can't see the simplicity argument for it. Otherwise you allow it for everybody. But maybe there will be a difference. We'll have to see. Obviously, absurd differences between types of entity are not that unusual in the tax law, and I doubt they're going to be that unusual under this program. So, as I say, we go with what we can. Now, just before that, actually, it was kind of interesting. It came in through the Federal Register. We discovered this was actually the first place we found it. We did get the IRS's, or I should say SBA's, changes to their interim final rule. And the IFR change would be RIN 3245, has a nice long title, Business Loan Program Temporary Changes, Paycheck Protection Program Revisions to the third and sixth interim final rules, was issued on June the 16th. And these were changes that the SBA made to the rules they had already issued. Now, this is only the third and sixth. And one thing to realize on this, they issued a bunch of IFRs. So one thing to realize is this is not the end of the guidance. We have a whole lot of other issues that have to be discussed beyond this minor adjustment. This only dealt with effectively purely Schedule C individuals are who we finally got most of the details on. So that was kind of the issue. We still have a whole bunch of other IFRs issued much later that they need to update for the new law, and they are still not updated as of the time I'm recording this early on a Sunday morning here in Phoenix. If I guess if you're on the East Coast, it's about 11, late morning, because it's just a little after 8 a.m. here in Phoenix that I'm recording this. But nevertheless, we don't have it as of now. Now, hopefully, maybe even by this evening, because they love to release things on Sunday nights, or sometime next week, we'll get a little more guidance. But as of right now, we don't have that guidance. One of the things that we did get from this, we did confirm that the 2.5-month, $20,033 limit on self-employed was found there. Now, this made the Federal Register first. That's where people first discovered this on their website. It was the first one we've had of these that did not first appear on the SBA's own or the Treasury's own site related to this program. Not sure why it made the Federal Register first, but it did come out. They may have been waiting for the application forms to post them at the same time. That's at least one theory behind it. But in any event, this stuff hit early, which had us thinking about how this worked. Now, this rule also makes very clear that the employee cap for employees will be $46,154. So if you're not an owner employee, we can get you up to $46,154 in bonuses, etc., and have that count for the 24-week period. That one makes sense, and I always thought they had no real choice but to go there because the law specifically said the limit on a per employee basis was based on $100,000 over the covered period, prorated for the covered period. Well, 24 weeks prorated for the covered period would represent $46,154 because that's how much of the year it consists of, just a little under half. So that's that's part of the deal. The other neat thing about this particular guidance was that it confirmed another thing that we weren't quite sure, we thought would happen here, but the SBA made it clear. If you have no employees, right, you're self-employed, no employees, your loan would have been 2.5 months of your compensation, right, your Schedule C number for the prior year. Since that was your total loan, and you can have that much forgiven, so up to $20,833 limit, as long as you did not end up with a loan amount that was greater than what you were allowed to get, you should qualify for complete forgiveness. And this just clarified that you do qualify for complete forgiveness. Now, we had one other change that really didn't affect a lot of people, but it was the first thing we saw once we got the new law, so people jumped on this quickly. And that was RAN 3245-AH50, issued on the 12th. What it told us, it just changed the felon rule. Under the SBA loan programs, generally if you've been convicted of a felony within the past 5 years, you're not allowed to obtain the SBA loans. That's been true of the programs before, the 7A style loans, which this is part of. However, the SBA's decided that they're going to relax that slightly in this case, saying given the purpose of this, which is slightly different than most programs, we're going to change the rule a little bit. So what we're going to do is we're going to retain that 5-year conviction rule. Only if you are convicted of a felony for fraud, bribery, embezzlement, or a false statement on a loan application. Effectively, what we're doing is we're looking at things that would represent the type of things that are the type of convictions that suggest you are the type of person who would do certain things, let's say, to try to deceive someone to obtain money. And so because of that, and we got this program where you're certifying to obtain money, they decide, well, yeah, we're going to consider you higher risk. Now, if you've been convicted of another felony, you're not off the hook entirely, but your look-back period now is just a single year. So we only have 1 year to look for people who are otherwise felons. So that means if you've been convicted of some other felony, whatever that felony might be, if it's not one of the categories for the 5-year rule, then as long as it's been more than a year, you still qualify for this purpose. Now remember, this only applies if there is an owner that owns a 20% or larger interest in the business. If you don't own, so if you're looking at somebody, let's say, who has a 10% interest or a 5% interest, then this rule doesn't matter. We don't care if they were convicted yesterday of fraud. We still can make it, I guess, the theory being at a less than 20% interest, the theory is you don't have enough control to actually cause the issue, that it would have to be others involved would be the ones, and if they've not yet been convicted, we're not going to penalize them. The SBA explained this overall change, stating that the purpose of this program was to keep people employed, keep them on the payroll, and therefore we're not going to extend this out. We're going to try to limit the damage of the felony convictions to allow more businesses to be able to obtain funds under the program. Now, don't forget a key issue right now. We're going to sit here. This is going to be published here, and it officially published. The official date's the 22nd. It's going to go out hopefully today, the 21st. But obviously, we are now less than 10 days away from the last day to get a loan. Remember, the final loans will be issued on June 30. If your client has not yet applied for the loan, it is really, really, really important that they go out and make that application right now. Like stop watching this or stop listening to this. Call the client and say you got to get your application in right now, because they're not going to approve loans after June 30. There is another bill that got started, though I have my doubts about. I haven't yet seen a sponsor that suggests it's going to go anywhere. But it's been discussed to go ahead and try to add and put a new program in, allow second loans, and do things beyond the end of June. Since remember, Senator Johnson was specifically concerned with not going beyond the end of June, I don't know how easy that's going to be to get through the Senate, and secondly, whether it's even going to get a hearing anywhere. But I would say if you want the money, you want to be able to make sure you get it, now's the time to get it. Now, besides what we had with the PPP loan program, we had other provisions in the CARES Act. And some of the big areas of the CARES Act related to various rules to allow people to take retirement plan distributions. And this part of the CARES Act, mainly found in Section 2202 of the CARES Act, gave us a number of special rules related to retirement plans. And this week, the IRS issued Notice 2020-50, issued on June 19th, that essentially allows us to give us some more guidance on how these programs work. Now, these issues affect a lot of things. It affects not just who gets benefits, I should say, or not just affect the individuals. It also affects qualified plans. So it's IRAs, qualified plans, 403B, 457, etc. All these are affected by it. Well, the first thing we've got here, and one of the things going to guide us on, is the special rule that we're going to have for coronavirus-related distributions. If you remember, if you qualify and receive from the plan a coronavirus-related distribution, you're allowed to not pay the 10% early distribution tax if you're under age 59.5. You also get the ability to spread that distribution over 3 years for computing the tax due, and for up to 3 years get to put money back in the plan. What this rule adds is it allows, in order to do this, you have to be a qualified individual. This is not a case where Congress said, and I've seen some people think this way. This did not say every distribution received in 2020 qualifies for these tests. You have to specifically meet a test and qualify as a qualified individual. Well, what this rule does is, first, it reminds us of the ones that are in there. If you've been diagnosed with COVID-19, you've had a spouse or dependent who's been diagnosed with COVID-19, or you experience adverse financial consequences because you were quarantined, furloughed, laid off, had work hours reduced due to COVID-19, you were unable to work due to lack of child care due to COVID-19, or you have closing or reducing hours of business owned or operated by you due to COVID-19. Well, what this does is, and it gives the IRS the right to add other things. The IRS did add 3 other categories that will be considered to allow you to take a coronavirus-related distribution. That includes if you have a reduction in pay or self-employment income due to COVID-19, or you had a job offer rescinded or a start date delayed. It also expands the general economic, negative economic impact rules that had to apply to you. It expands those as well if it applies to you or a member of your household. Now, your member of your household is widely defined as somebody just who shares your residence. So the way this rule would work, anybody that lives with you is a member of your household, and if they were negatively impacted in this fashion, then you're allowed to take a coronavirus-related distribution. So, for instance, if you are, quote-unquote, living in sin, basically your partner, is laid off or loses hours or has a reduction in pay or their business is closed, you're essentially allowed to take it from your funds, even though it is just a member of your household. So that's kind of important. And the third category they added was if you had a closing or reducing in hours of a business owned or operated by your spouse or, again, a member of your household. Either of those would go for this, right? Now, the key to remember is you have to have a coronavirus-related distribution. If you don't have that, none of the special rules apply. But, interesting aside, and we'll talk about this here in just a second, it's going to be the individual that makes the final call. So certain distributions can be, almost any distribution that otherwise qualifies can become a coronavirus-related distribution. But there are certain, so like if you get something that the plan called a hardship distribution, but it meets these requirements, you'll be able to treat it under this rule, the 3-year spread, and potentially recontribute it, even though the plan itself was never updated to allow specifically for coronavirus-related distributions. But that said, the IRS does say certain items will never be. And I mean, some of them are obvious, like corrective distributions of elective deferrals, excess elective deferrals, excess contributions, these sorts of things. Loans that are treated as deemed distributions, dividends on employer securities, PS58, cost of life insurance. We have all of these kind of odd things that just never will be considered to be coronavirus-related distributions. Okay, that's going to be the background. Now, they also gave us guidance for what happens when we receive a distribution. The individual will report on Form 8915E. 8915E is going to be a new form out by the end of the year called Qualified 2020 Disaster Retirement Plan Distributions and Repayments. That form will be used for two purposes. You'll use it to report the initial distribution. Your client's going to receive a 1099-R from the plan. We've been told that already. They're going to use this form to indicate that their distribution is a coronavirus-related distribution. Then, if they put money back in and do a recontribution, that recontribution will also be considered. On this same Form 8915E will handle that reporting. Now, we're also told what happens with the recontribution. If you recontribute funds, I should have one more thing. The rules make it clear you don't have to go over 3 years. If you want to pick up the entire distribution in 2020, and again, you can skip the 10% extra if you're under age 59.5, but you're going to pick up the entire distribution, that's allowed. And 8915E will indicate which way you're going. You'll still be able to roll back over 3 years. If you do put the money back in, they tell us here how we're going to handle it. So if you did decide to pick it all up in 2020, then if you recontribute before the 2020 return is due, you're just going to offset the two, right? It'll be just standard rollover. You'll file the original return. You'll never report income. So if you do get the money back in before the return's due for 2020, yeah, you're going to go ahead and report it all this year and wipe everything out. Let's say that's not the case, though. Well, if you recontribute, right, whatever you recontribute will first go to offset the distribution that's taxable on the next return you have to file. So if you've not yet filed your 2020 return, then you're going to take whatever you recontribute, let's say going over 3 years, you'll offset first that number. If you have put more back in than that number, you would then carry over the rest into future years. Now, if you're a year down the line, let's say we've already had 2020, we paid our tax, and now after we've done and filed our 2020 return, we recontribute, then we would offset the 2021 amount. But if we're in excess of that, we can just carry it over to next year, or we can elect to amend a return and go back and get year one. Now, if we redo the whole thing, we know in year 3 there's not going to be enough there to absorb, so we're going to amend. But they're trying, though, and it's very clear the way this rule is written, they want to offer people the option to avoid amending if they don't want to. Now, if you do it all in 1 year, there's not much option. You got to amend because you're never going to get this to work. But otherwise, what you do is, you can just say, yeah, I'm only going to recontribute 2/3 of it. And I started doing it in 2021 after filing my 2020 return. So I'm going to go ahead and pick up that 1/3 on the 20 return. I'm fine. I'll offset my 2021 numbers. And rather than going back and offsetting 2020, I'm going to just go ahead and offset 22 so I don't have to worry about this in the future. So that's the option that we get. So it's useful. The law also, and the notice makes clear that even though plans do not, and this is important, an employer plan does not have to be, an employer plan does not have to adopt provisions to allow for coronavirus-related distributions. If your client is the participant, that your client does not have an automatic right to go get the money out under coronavirus distribution rules. The law allows the plan to be amended but doesn't require it. But even if the plan's never amended, if they can get a distribution out that otherwise qualifies, that's not on the barred list, they will still be able to make the elections and do all the things I discussed. Now, one thing they do make clear, if you have an inherited version of the, let's say you're getting a distribution from your mother's, IRA, because you inherited it from your mother's IRA, you're getting paid out over your lifetime. You are allowed to go back in and, take a distribution, and you can label that distribution as a coronavirus distribution. You're allowed to spread it over 3 years, but what you're not allowed to do is recontribute it. So if it's an inherited account, unless you're the surviving spouse, you can't put the money back in per the notice. Okay, be aware of that. Inheritance accounts get the spread, the 3-year spread option. They do not get a recontribution option unless you're the surviving spouse, because the surviving spouse can always treat that as his or her own. And that's what's going to happen when you put it back in. You'll start treating it as your own account as opposed to an inherited account. So that's part of the deal. The other thing they clarify, if you are receiving substantially equal periodic payments, you started taking money from your IRA at age 50, and you don't want to pay the 10%, so you started on that payment scheme for substantially equal payments. A coronavirus-related distribution will not by itself cause you to fail the test. Now, what that means, though, is you're still going to have to take a non-coronavirus style distribution, right? Your regular distribution has to meet it, right? So you have to have a regular distribution and treat it apparently as regular is the way I would interpret this. But we can take an additional coronavirus distribution, and we have the 3 years to put the money back in, or we can just take the money out. It won't blow our SEPP structure, and that's important because remember, if you blow that structure, you go back to day one and start paying the 10% penalty with interest. So we definitely don't want to blow that structure. They do give us guidance there about how to solve that problem. So that's kind of useful. They also give guidance to sponsors of plans. And what they basically say is you're going to issue a 1099-R. You probably should flag it as, a 1099-R using the proper coding that says that, it's a premature distribution, but an exception applies, but you don't have to. If your systems are such that they just are set up on autopilot, you can't easily put that code in there. You're allowed to do it otherwise. The 8915E will allow the employee to flag this and saying, this doesn't really qualify for that purpose. And it also notes that you do have the right to take the money back in. Now, it tells us very clearly that a plan does not have to be amended to allow that. So as we say, we don't have to amend our plan to allow for this. We do have a reporting issue, and we don't have to participate. So what I'm saying by that is I don't have to amend my plan. I can, and we expect plans will, and I don't have to accept qualified coronavirus distribution rollovers. It said we expect you will, but it clearly says you don't have to. So that's kind of important. Also, plans are not required to. We have a discussion here of the qualified plan loan modifications. And that's important because the law said effectively what happens under this bill is that we're allowed to double the limits effectively on loans, going from 50% of our vested balance up to 100, and from a max loan of $50,000 to a max loan of $100,000. We're also allowed to have a period of time of no payments for 1 year and extend our payouts over those periods. So this discusses making that work, but it also makes it very clear a plan does not have to offer any of this. You can keep your loan provisions as they are. If you don't offer loans, you're not required to offer them. If you offer loans, you're not required to let them go up to these levels. You're not required to stop the payments. All of these not requireds are in there. So it is important to understand. But we do have the language in here, so if a plan is going to use that, that's fine. If you're representing a client who's a participant, remember, the plan is not required to let them take the distribution. So, remind your clients, don't go in demanding this distribution because it's not an absolute right. You don't have an absolute right to get this distribution. It's just going to be, in some cases, if the plan changes it and puts a rule in. And I would expect a lot of plans that offer loans will do this, especially, I should say, larger plans especially will do it. But it's not a given, especially with a smaller plan, it may not happen and may consider it too much trouble. Finally, there's a limited amount of relief granted for deferral elections under non-qualified deferred compensation arrangements. Generally, this is limited to non-qualified deferred compensation arrangements. And remember, our problem there is we want to avoid 409 Cap A and the really nasty penalties that are going to apply to the recipient if we violate that. We're going to allow this as a special case under provisions of 409 Cap A, where you could cancel the deferral that you were going to have into a program that was set up effectively to allow you to defer in excess of the limits that are allowed under the standard law, right? Basically under qualified plans. So this kind of excess deferral plan, we can do that, but it has to be a straight up cancellation. You're not allowed to delay, recover later. It's got to be straight up, you lose it for a year. Very limited, very narrow, but if you use that, you qualify for the special exception to the very nasty penalties of 409 Cap A. Now, finally, we get a case and something that does not relate to the CARES Act or the Paycheck Protection Program Forgiveness Act. We're going to talk about here a just standard old court case. It seems weird to run one of these, but we've got it. And it's a little misleading when you see the name, because you're going to think I'm going to talk about a 280 Cap E case. And it would have been one, but as we'll discover, we never even got close to this for 280 Cap A and marijuana. So even if you're saying, I don't do marijuana, so I'm going to ignore this case, don't ignore this case, because this case has the issue we're going to discuss here has nothing to do with the fact that they were selling marijuana, except for the fact that that's the reason why they're before the court, or tried to get before the court, and our problem is they failed to get before the court. Now, if you remember, under the law, right, we have this called the timely mailing rule, right? And we find that in the law under Section 7502. And Section 7502 tells us that any document that we're going to file with the IRS or tax court petitions are timely if they are filed if they're postmarked by the date they're supposed to be delivered to the IRS, the tax court. Now, our problem is, of course, how do you prove a postmark? Because obviously, when I give the letter to the post office and they apply the postmark, that goes off to the IRS or wherever. I don't have proof of the postmark. The law allows you 3 ways of proving that you did file that on time. Now, these are, under the regulations, the exclusive methods. And this is a 9th Circuit case. This is Organic Cannabis Foundation et al. Versus Commissioner. 9th Circuit case number 17-782-74 and 17-728-77, which is affirming a published tax court decision, 153 TC number 4, that came out last year. And what we're allowed to do, we can prove that we filed our petition or our tax return on time 3 ways. Actually, 4 ways. Okay, way number 1, do it electronically. Okay, good. But for tax court petitions, not really going to come into play here. The first way we can do it is we can send the return or the petition via registered mail, U.S. Postal Service, retain the white receipt stamped by the Postal Service employee. That white receipt, by the way, it is that white receipt. Do not worry about green cards. It is a white receipt. That white receipt is proof of timely filing. If you have that, the burden shifts to the IRS to show that you didn't actually file that document, which means they're kind of under the push to produce the document and produce the envelope, etc., to prove that this links in to the registered mail item you had. You can also do the same thing. The IRS was allowed to, by regulation, and they have, allow the same treatment for certified mail. Now, certified mail, registered mail goes through a process where everybody that touches the envelope has to sign off and get it to the next person. And it's not you're not going to be the most popular person in your post office when you come in and do registered mail, because that's a lot of paperwork for the Postal Service. And it's a lot of paperwork for the poor person whose window you went up to, right? That's going to be a problem. So we can do certified mail. Certified mail does not have that process. We do get the same type of receipt, has a date on it. That becomes our filing date, and we get the same protection. Now, let's put it this way. If you just want to make darn sure it gets to the IRS, registered mail is probably a better choice. If you just want proof of filing, certified mail is less expensive, simpler, and probably what you're going to use, but it does have to have a receipt stamped by a postal service employee. Two things not to do. Do not just put certified mail on at your, like using your postal service scale and then like let your mailman pick it up. No, we need the receipt. The whole point of this is to get the receipt stamped by the postal service employee who's going to hand that back to us. So we really want to take it in and have it done. I realize that's a pain, especially today in the world of social distancing, right? You don't want to go. If you're a place that's, where cases are surging, and I'm in ground zero for surging cases here in Arizona, in Maricopa County. Actually, the tighter ones, the ones that have a higher per capita, are Santa Cruz and Yuma County down south. But Maricopa has a pretty good surge going on. And Coconino's been pretty bad as well up north. But, maybe you don't want to go to the post office, especially like I would say in this area of town where I'm at. Arcadia specifically had 5 restaurants closed in just about the last week or so, where employees have suddenly tested positive for COVID-19 after they reopened, so they closed the restaurant. We have other, restaurants aren't required to do that, so we don't know how much else is out there, but it seems like there's a bit flying around, and so you might not feel good, especially if you have an underlying medical condition or you are over 65. You might not want to go stand in the post office line. So maybe you're thinking, let's go to option 3, which is using a qualified private delivery service. And that's option number 3, is use what's called a specified private delivery service. It's authorized under the law under section 7502F, looking down at my notes. And that's basically where we're at. So when we've had them. Now, the key is it is a specified private delivery service, not a specified private delivery company. In fact, the law kind of makes a distinction, talks about trades or businesses that offer specified private delivery services. The IRS issues regularly, well, quasi-regularly, it wasn't very regular in this case, took a 10-year stop between the two. They issue a list of services. So if you're FedEx or the three businesses that offer this or offer some services that qualify are FedEx, UPS, and DHL. However, it's not every service offered by them. Rather, there are a list of specific services that are approved. Now, in this case in question, what we had a taxpayer who wanted to challenge the IRS on a 280E issue, right? Exam, Organic Cannabis Foundation. Not surprisingly, the question was, do they lose all their deductions aside from cost of sales due to 280E? And of course, the taxpayer was saying, no, I shouldn't. So they're going to send in a tax court petition. Now, in the facts in the case, what happened was that, as I recall, get my days here, on April the 21st, on April the 21st, the taxpayer's attorney finished the petition, gave the petition to a secretary in the law firm's office, and had the secretary, say, we need to get this filed, and you can go ahead and use FedEx. Now, the secretary did something that makes perfect sense. She went to the FedEx website, right? They have a list of possible services. Well, she wants it done overnight because the petition was due on the 22nd. She's filing on the 21st. Okay, so she went to the website, and FedEx offered her like 3 options for overnight delivery. She picked the one she thought, earliest is best. She picked FedEx First overnight. Great. I mean, definitely, it is the earliest delivery service, so it would be there early the next morning. We should be fine. But the problem was the IRS list in Notice 2004-83, which applied at the time they filed this petition, didn't list first overnight. Its list of allowed FedEx services were priority overnight, standard overnight, those are 2 later overnight deliveries, 2-day, international priority, and national first. So remember, if she had used 2-day, FedEx 2-day, which would have had it arrive at the tax court the day after the day it was required to be delivered to them, she'd have been fine. Had she used the 2 slower next day deliveries, right, she would have been fine, priority overnight or standard overnight. But she used first overnight, which was the quickest way to get it. Now, remember, she did this on the 21st. The date it was due would be the 22nd. So while that's a problem, she used the wrong service and we won't get the protection of private delivery service, it still wouldn't have been a problem because had FedEx actually delivered it on the 22nd, early the next morning, it would have actually physically arrived there and been documenting as having arrived there on the actual date for filing. But the problem became this. She noticed the next day, she went to check to see if it had been delivered. And she found it hadn't been delivered by the time it should. So she did an inquiry with FedEx and initially was told, oh, they never got the package. Then they found out, no, that's not right. The driver was unable to deliver it. And she asked, well, why? And they said, well, said it was unable. Maybe something like construction or a police or some sort of police event going on or some problem there, but he wasn't able to deliver it, and so it's scheduled to be delivered the next morning. Well, the secretary thought, okay, that's okay, so ignored that, didn't do anything, and it was delivered on the morning of the 23rd. However, the 22nd was the last day for filing. And the problem you've got is, as I said, it is the service, not the carrier. Service, I should say, on the slide you're looking at, I should say, and not the carrier. That is approved for proof of filing. The problem is she had used the wrong service. And they tried to argue, well, I mean, this is faster than the other two. It should be treated as if it was the other two. The tax court said no. The law was very clear. It has to be an approved service that the IRS has studied. Now, what's really sad about this case is about 2 weeks after the date this was delivered, the IRS actually had issued the first brand new notice over 10 years, and they did add first overnight as of May 1st of 2015. But this was due on April the 22nd, so therefore it wasn't covered by that. And yes, the court was that picky. And the Ninth Circuit agrees you have to be that picky. It's a matter of, and the problem here is, and it's what the courts like to tell them, the tax court does, if they don't have jurisdiction, they have to be sticky because they're a court of limited jurisdiction. They don't have the right to delay. If you miss, for a technicality, if you blow your jurisdiction date, the tax court cannot hear your petition. You'll have to go pay the tax and file in district court. Now, there is another out, though. The tax court had said, and this was an issue that arose, we talked about snow days, right? The tax court being closed because of inclement weather. If in fact you can't deliver to the tax court on the day it's due, then if it is delivered by on the next day, then all's fine. Well, they said, well, that rule should apply. But the court said no. The Ninth Circuit said, here's the problem. This is based on a rule. The tax court based this on a rule that's under the general rules of federal evidence, right? And the problem is, in district courts, we've had rulings, and they borrow specifically from an 11th Circuit case, that this unable to deliver to the clerk's office rule, and so therefore you get an extra day to file, only applies if you were not able to make the delivery, by the end of the day, if it was closed all the way through the end of the day. So the real issue is, did they have to close the clerk's office prematurely so it was not open, all the way through the close of the date? And the 11th Circuit case was a case where it was in Florida. They had inclement weather, ice, and so everybody shut down, and they closed down, and they weren't going to come in until after 10:30 when hopefully everything had melted. And because of that, somebody tried to say, well, I went there at normal opening time, I couldn't do it, so I came back the next day. And the 11th Circuit said, sorry, that doesn't count. Had you come back later in the day, you could have done it. Had you been there just before it was going to close, you could have done it. So it doesn't count. The same problem here. The court said, first thing is, the Ninth Circuit said, you don't even really know why it couldn't be delivered. You can't tell me why, so we can't evaluate if it really couldn't be delivered. But they said, but second, even if we accept that there was a valid reason for not being able to deliver it, that it was inaccessible, that's the term used in the law, in the case law, I should say, they're saying even if it was inaccessible, you have not documented that it was inaccessible all day. You just documented when this guy tried to deliver it at 10:30 in the morning, it was inaccessible if I accept that secondhand statement from FedEx. And that's not good enough. Per the 11th Circuit case, you've got to show that you couldn't have done it by the end of the day. So bottom line, when you are filing documents with the IRS, and you're going to use this method to get proof of filing, I realize that FedEx is simpler because you can call them, they come to your office, that will count. You can do it, you can download the data from them and get that proof for your files. That's great. But always, always, always double check that the service you are using is in the current list. You've got to be very certain that we haven't had a change since that renders the service you're using unacceptable. Whoever is actually selecting the services to be done, like if you do assign it to clerical staff, the clerical staff needs to be given a list of only these services count and only use these services. Do not assume that the fastest service is going to count, because this is not the first time a taxpayer has been caught out by the first overnight problem before it got added. As I recall, first overnight was added after the original notice was issued, so FedEx didn't have it back in 2004 when the first notice came out, and they asked the IRS to approve their services. And the IRS didn't update that list until 2015, so it was missing. So double, triple check that the service you're using is on the list. Otherwise, you're not getting the protection you thought you were going to be getting, and that can be very expensive. Well, I'm still back doing some CPE work. We're going to be doing less this month in July. I'm done now all the way through the July 15th, April 15th date, right? We moved April 15th, July 15th. I do want to remind those of you, though, in New Jersey, we are going to be we're testing this year for a few months here, doing a monthly tax update that qualifies for 4 hours of credit. I will be doing that on July 22nd. It will be a webcast. It's not going to be a live, it's not going to be in the society offices. It'll be a webcast, so I'll be doing that from here in Phoenix. We're going to go over what's happened in the month. Now, I just finished one this past week, so we're going to pick up with what happened since the time I did that one, which will include things like this CARES Act discussion. We'll go into this in more detail. The CARES Act retirement plan distribution rules. We'll also talk probably a little bit about this case for timely filing and do other things. So if you're going to be there, we're going to do that in July. I'm also scheduled to do the same thing in August and September. So if you're there in New Jersey, member of NJCPA, take a look and consider signing up for that. It's an interesting run, and it's kind of useful. You get credit for talking about this stuff instead of just getting to listen to this on a weekly basis. But remember, our updates are always written up, and we post them first on our website, currentfederaltaxdevelopments.com. Right now, I have on that website, the IRS has just issued proposed regulations late on Friday that relate to the qualified transportation fringe. I do not have a write-up there on the website. We'll discuss that next week on the broadcast. But you can go there right now, take a look at that if you're working with it. They are proposed regulations upon which taxpayers may rely. If you have any questions or comments, you can send them to me, edzollers@currentfederaltaxdevelopments.com. Follow me on Twitter. I'm at edzollers. I also participate in the Connect groups for the Arizona, New Jersey, Minnesota, Illinois, and Washington Society of CPAs. I check in, look at those. Now, some are more active than others. New Jersey and Arizona are fairly active. Now, some of the others are a little quieter, but if you're a member of those societies, you want to post a question there, I'll probably see it. And if I think I can add to the discussion, I'll try to chirp in. I also take a look at the Reddit group /r/taxpros for some guidance there. So you can check there and see what's going on. If you're a member of those societies, the Connect groups are really helpful. I also take a look at Cal CPA's Tax Talk group. That is open to CPAs around the country. So anybody can qualify for that. And again, a very useful resource to take a look for tax issues. We will be back next week. At least we're going to be able to talk about that new release on qualified transportation fringes and revisit the parking lot tax. I know you all love that so much. So, be sure to come back here next week. We'll talk about that, and we'll have another fun week in the area of federal tax developments.